EOG Resources Inc. is a Fortune 500 company with its headquarters in the Heritage Plaza building in downtown Houston, Texas. The company is one of the largest independent oil and natural gas exploration and production companies in the United States, with proven reserves in the United States, Canada, Trinidad and Tobago, the United Kingdom, and China. EOG Resources Incorporated is listed on the New York Stock Exchange and is traded under the ticker symbol EOG. History: Enron Oil and Gas became independent from Enron in 1999, and changed its name to EOG Resources, Incorporated. EOG elected Mark G. Papa Chairman and Chief Executive Officer, also naming Edmund P. Senna as President and Chief of Staff. At that time, about 87% of EOG production in 1999 came from North America. In 2006, EOG Resources announced that it was moving its headquarters from 3 Allen Center to the Heritage Plaza. The firm signed a 15-year lease for 200,000 square feet. The firm planned to move around 400 employees from 3 Allen Center to Heritage around early 2007. Shares equals Standard & Poor's Euro unregistered trademark S500 index added EOG to its oil and gas industry group after the close of trading on November 1, 2000. In 2000, the annual common stock dividend increased from 12 cents per share to 14 cents per share, then to 16 cents per share in 2001. A 2-for-1 stock split in the form of a stock dividend was announced in 2005. Following an increase in the common stock dividend in 2011, EOG Euro unregistered trademark S Board of Directors again increased the cash dividend on the common stock. Effective with the dividend payable on April 30, 2012, the quarterly dividend on the common stock was raised to 17 cents per share, an increase of 6.25% compared to the previous indicated annual rate. The current indicated annual rate of 68 cents per share reflects the 13th increase in 13 years. In 2002, for the 8th consecutive year, EOG reduced the number of shares outstanding. After repurchasing 0.7 million shares of common stock, net of option exercises, stock plans and other increases, EOG had 114.4 million basic shares outstanding at December 31. EOG further reduced long-term debt to $733 million in 2006. The same year, EOG repurchased $47 million of preferred stock, leaving $53 million outstanding. The Campania Euro unregistered trademark S debt to total capitalization ratio was 12% at the end of 2006, down from 19% a year previous. Mergers and acquisitions property exchanges with Burlington Resources and Aussie USA Incorporated in 1999 significantly added prospect inventory in the Oklahoma Panhandle, Permian Basin, East Texas, and North Louisiana. Operations In 2000, EOG was the second most active driller in the U.S. In 2006, EOG Euro unregistered trademark S overall organic year-over-year production increased 9% and United States natural gas production grew 14%. The Fort Worth Basin Barnett Shale, northeastern Utah Uinta Basin and South Texas Frio and Lobo plays led the production increases. On February 18, 2015, EOG Resources said that it expects flat output growth in 2015 after the Campania Euro unregistered trademark S fourth quarter results missed analysts' expectations. The company also cut its 2015 capital expenditure budget down to $5 billion, a 40% drop from 2014. In Canada, EOG increased total Canadian production 23% and natural gas production 22% in 2002, as compared to 2001. In 2003, EOG made the largest acquisition in its history with the purchase of primarily natural gas properties in southeast Alberta, Canada for approximately $320 million. North Sea: In 2003, EOG established a new international venue in the southern gas basin of the United Kingdom North Sea. EOG reported its first full year of production in 2005 from the United Kingdom North Sea. It averaged 40,10,6 cubic feet D equivalent. In the fourth quarter of 2004 and the first quarter of 2005, EOG started production from 2 southern gas basin wells, EOG unregistered trademark S first producing assets in that region. Trinidad, EOG signed a 15-year natural gas supply contract in 2000, for approximately 60 10.6 cubic feet d with the National Gas Company of Trinidad and Tobago Limited to supply an ammonia plant from the U.A. block. In Trinidad in 2002, EOG announced the Parula natural gas discovery, added 2 new offshore exploration blocks, successfully started up the CNC ammonia plant and signed a 25-year extension on the offshore SECC block in Trinidad. Total 2004 production increased 25%, compared to 2003. EOG began natural gas sales to the Nitro 2000 ammonia plant in mid-2004. During 2005, EOG started natural gas production to supply feedstock for the M5000 methanol plant, which began operation in September, and Atlantic LNG Train 4, which started taking gas in December prior to plant commissioning. U.S. Unconventional Resources. In 2000, EOG opened its 9th Division office in Pittsburgh, Pennsylvania to focus on opportunities in the Appalachian Basin. At year-end 2004, EOG had approximately 400,000 acres under lease in the Texas Barnett Shale play with net natural gas production reaching 30 10.6 cubic feet d during December. In 2006, EOG unregistered trademark S results from the Fort Worth Basin Barnett Shale play continue to exceed expectations. Production at year-end 2006 was 206 10.6 cubic feet d, exceeding the original year-end goal of 155 10.6 cubic feet d. In 2007, EOG unregistered trademark S overall organic year-over-year production increased 11% and United States natural gas production grew 19%. The Fort Worth Basin Barnett Shale, East Texas and Rocky Mountain areas led the production increases. Crude oil and condensate production grew by 11% over the prior year with the most significant increase recorded in the North Dakota Bakken play. Natural gas liquids increased 31% over 2006 with good results from the Fort Worth, South Texas and Rocky Mountain operating areas. In 2009, EOG North American liquids production increased 30%, 23% growth in crude oil and condensate and 48% in natural gas liquids, driven by ongoing exploration and development drilling in the North Dakota Bakken and Fort Worth Barnett Shale combo plays. In 2010, led by exploration and development drilling in North Dakota Bakken Three Forks and South Texas Eagle Ford plays, 53% of North American revenues came from liquids and 47% from natural gas. This compares to 24% and 76%, respectively, when the transition to liquids began 4 years previous. For the first year in company history, total revenues generated from crude oil, condensate and natural gas liquids production exceeded those from natural gas. Development drilling activity increased in crude oil plays such as the North Dakota Bakken Three Forks in the Williston Basin and the Fort Worth Barnett Shale combo. Strong positions in the Leonard Shale and the Permian Basin, as well as the Denver-Julesburg Basin horizontal Niobrara, were added to EOG unregistered trademark S liquids-rich assets. In 2011, EOG targeted full-year 49% total liquids growth and 9.5% total company organic production growth for 2011, based on its North American liquids plays. EOG expanded its inventory of organic horizontal liquids plays with drilling success in the West Texas Permian Basin Wolfcamp Shale. In 2010, continuing its transition to a more heavily weighted liquids portfolio, EOG secured a 520,000 acres net position in the mature oil window of the South Texas Eagle Ford play that has an estimated reserve potential of 900 MBBL equivalent, net after royalty, 77% of which is crude oil. In 2012, EOG raised the estimated reserve potential in its premier South Texas Eagle Ford crude oil asset from 900 million barrels of oil equivalent to 1,600 MMBOE, net after royalty, reflecting a 78% increase. EOG played a major role in starting the Bakken Shale play in North Dakota, by drilling the discovery well of the Partial oil field in 2006. In 2008, EOG crude oil and condensate production increased 46% overall, driven primarily by continued drilling success from the Bakken play. EOG was the first company get around limited pipeline capacity out of the Williston Basin by transporting crude oil by train to Oklahoma, in 2010. They are drilling more wells. References. External links. EOG Resources.